Okay, well, good morning to you and welcome to my webinar on range trading. I'm Simon Coulter, Head of Development and Risk Management at Mahi FX. Here's just a little bit about us. Today we're going to be looking at technical tools that assist us in trading ranges, looking at support, resistance, a little bit of theory on range trading. I'd like to talk about range trading because I think many people overlook how much money can be made from trading ranges in pursuit of that glory trade. And the reality is that a huge amount of money can be made trading ranges, especially often ranges are more typical than strong trends. And even in trends, many ranges may appear intraday or over a few days that aren't very apparent when you're looking at a longer-term chart. And that would indicate that it's only gone one way, but when you look closer at the charts, you can see that often during the day there's great ranges. It probably hasn't been one of the best years for range trading, with pretty directional markets out there on the back of, quantitative easing. The fiscal cliff, sovereign debt issues, but a lot of the time we do typically get ranges. The other reason I think it's important to discuss it is when we've made a lot of money from trading ranges, we can use this P&L and really put it to good use when things start trending strongly. So moving on to what we're going to cover here today, we're going to start with a bit of theory on why currencies range, currency types and market conditions that are ideal for range trading. But the focus is going to be on trading ranges and the practical implementation. We're also going to look at if the market is a ranging or a trending one and what the transitions are between them, which indicators are suited to helping us trade the range, which help us tell when it's moving from a trading range to a trending market. We're going to look at a bit of positioning for breakouts and why it's important to rotate risk during the range, and some ideas for anticipating potential ranges prior to them fully forming. This is because, as you'll know, a large part of the time, unfortunately, a large part of the range might have elapsed before we know what the range is. So we're going to try and use a few ideas to come up with how we can predict the range in advance. So we're going to do this, we're going to look at a study of the ideal range that I found earlier in the year. We're going to compare indicators off the base parameters, so we're looking at the performance of the core indicator, and the results aren't doctored to make any indicator look better than the other. So this way we're going to have an excellent case for comparing the respective performance of each indicator during this period. So why do currencies range, and what type of market conditions are well suited to trading ranges? So as you probably know, they're going to range when supply and demand is finally balanced, neither side feeling that urgency to clear the position at levels greatly altered from what we just had previously. Support and resistance aids range trading as clusters of buy and sell orders at the extremities neutralise that supply-demand mismatch that is common in more neutral areas of the range due to a lack of orders in the market. So when the supply-demand balance returns to a more natural level, we see the market return to the middle of a range and awaits the next event at this point. And as you all know, for every buyer there's a seller, so it's the participant's level of willingness to clear the risk at the new levels which dictate whether currencies are volatile. You often hear people saying when something depreciates in price, there's more sellers than buyers. It's maybe true, but the real point is just how desperate the one side is to move the price. So with that in mind, we've sort of got the answer to what type of market conditions are going to support range trading. They're going to be markets that are devoid of major economic releases. So you need to remember, if you're range trading, to monitor the market very closely during releases, and it's normally wise to pull your orders, especially if they're in the middle of the range. So then you can sit back and watch that price action around the support and resistance levels during the release. where one of those releases has varied greatly from expectations, you're going to see greater volatility, obviously. That can often be for days, actually, after the event. And these can be the times when ranges are going to break. And then we can see some pretty big ranges too, where a series of economic releases seesaw between positive and negative for a country, and where macroeconomic themes dictating trade are going in and out of vogue. See, that's a classic example. That's a risk-on, risk-off theme for commodity currencies that you often hear people talking about. Normally, where the players lack interest, we're going to see days with low volatility. You can often see this in the Asian sessions and major market holidays, but you need to be aware that occasionally these days can be highly volatile just due to that lack of liquidity when a flow needs to get urgently cleared. But I like some of those days. They can be great days to get your position set on the range extremities. And in a moment, I'm going to talk about some of the currencies which are great for range trading. And during that, one of my favourites during these sort of thin periods with low liquidity, I like trading the Aussie Kiwi. And what you see is that when a flow comes through the market, it might often push one of the legs out. So if the market's pushed that across, so it's a highly correlated currency pair that I'd be focusing on via one leg moving like the Kiwi, that can be a great time to get set at an extremity in that pair. So what we're doing here is we're reducing that dollar systematic risk, and we're playing a waiting game until the contra flow goes through one of the other legs and pushes that pair back into the range. You do need to be aware, though, there is one trick just where there is actual cross flows, where the legs are getting executed at different times. You need to be careful about that. So what sort of currencies are most suited to range trading? Well, I mean, all currencies trade ranges at one time or another. Well, that shouldn't surprise that countries or zones with highly correlated currencies are less volatile and will typically trade in more stable ranges than those that aren't. For example, against the dollar, the Aussies traded between around 47.75 in 2001 right up to around 110.80 in 2011. So, whereas against the Kiwi, it's only traded sort of 104.30 to 137.90 over that same period. There's plenty of other examples of highly correlated currency pairs like Noki Stocky, the Euro Sterling's relatively highly correlated, Euro Stocky, Euro Noki. But like any currency, can get strong trends in these pairs too when that equilibrium is disrupted. Even the Aussie's been very rangy for a large part of 2012 as that traditional correlation with commodity prices has weakened, as some of the central banks have been chasing this AAA sovereign credit, which has countered natural current account flows. So you can see even against the dollar, some of them can be pretty rangy in markets like this. Lastly, just on the theory side, factors that can have a strong influence over currencies giving rise to strong trends are things like themes in the market. Examples, like I said before, the sovereign debt issues facing Greece and Spain, and its effect on the euro, and other things like macroeconomic and political factors that affect the country's economic performance and pressure its currency over long periods. And over the long term, you've got factors like that reduce efficient resource allocations. You're thinking about issues that weaken purchasing power parity, like transportation costs, trade restrictions, differing labour laws, restrictions on the flow of labour, those sort of things. So moving on now, I want to have a look at this great range trading period and have a look at some of the indicators that we looked at and how they performed. So let me just expand this up over here. First couple indicators we're looking at here are the Stochastics and the Demarco indicator. We applied them with the default parameters. I didn't want to alter the parameters to try and best fit the indicator to the data and doctor the result. This is just to introduce rigidity to the rules and increasing that rigidity would only mean that they're more likely to break down the track. So we're just looking for the basic rules to guide our trading, and rules that can be used over, many ranges. Now, the trades we'd put on to after the range was established. So the arrows here are indicating the different trades that were put on. The stochastics, which is this bottom oscillator down the bottom here. We were putting on long trades when the percent quick line of percent K crosses percent D down here in this oversold zone. I wasn't interested in crossings up here where it's overbought. It would make no sense. So we went long at this area, squaring the trade when the pink quick line crossed the green line. We would square the trade. We would look to go short at the contra side up here when this percent K went through the percent D. So looking at the actual, some crossings outside, one more thing I needed to point out is that the crossings outside of these zones we wouldn't go long or short on. So we'd only, if that occurred, would only square up a previous long or a previous short. So we're only interested in initiating trades in these zones here, here, here. So we can see the indicator made around 300 pips during this 2-month trading period. It's a great period in March and April in the Kiwi. The maximum negative trade, so our worst trade, was around 66 pips, and the best trade around 89 pips. Out of 11 trades open, only 4 were losers. So we can see that the stochastics actually worked pretty well. Just have a look at the arrows here. You can see the long arrows denoting the long trades and the short trades. The short ones are squaring trades. It's the same for the Demarco, the yellow arrows here, the same thing. The rules for the Demarco were that would go long when it come out of the oversold zone, squaring it as it went up into the overbought and come back out. If it subsequently dipped back into this oversold zone after going long, would cut the trade. And the contra on the top side, if it went back up into this overbought zone, we'd got it wrong, the momentum had turned, so we'd stop out of that position. We can see, unfortunately, that Demarco was a pretty poor performer, really. In fact, excluding this final trade here, we can see, it didn't square up till well after the support line here had broken. That excluding that trade, we only made 68 pips. Including it, we made 330. The worst trade being a 90 pip loss. With this final trade, our best trade was 262, but only 78 actually in the range, so it wasn't a particularly great performer. The indicator held that last trade open a lot longer than the stochastics, and that's due to its lower sensitivity to the small retracements. So you can see a small retracement here. We got a crossing here on where percent K cross percent D, so that meant the stochastics trade was squared up from short, whereas the Demarco didn't call for a covering position until quite a bit later. So we can see this lower sensitivity that the Demarco has to against the stochastics. If you look at the orange initiation trades of the stochastics, they're always before, or pretty much typically always before these yellow arrows of the Demarco. So it was a less sensitive indicator and much better trading during the range. So we'll now move on to the RSI. We're going to look at firstly at the hourly RSI. Again, we're looking at the signals after we've seen the support and resistance. Arguably, we could have put on a trade, and I'm calling that the first trade here simply because it had come off this resistance. We saw divergence here at 0.1, and now, as is often the case with the RSI, it was probably divergence trades that really were the best. One here at 1, 2, 3, and to a lesser extent 3 here, and 4. Now, if the divergence, as we know, you get a new high set in the currency and a lower high in the indicator, or a lower low in the currency and higher highs in the indicator. So it was the divergence trades that performed pretty well. So let's just look at a few here at point 3. We failed around 25 to 30 pips from that resistance at 82.90, so we needed a reasonably wide stop, but a good move back down. Point 4 here, we broke old resistance around 82.90. Trade was presented here as a second run to 83.14. We saw a much lower reading than in the RSI. Although not strictly a classic divergence, definitely very similar. The opaque arrows around here and here were also divergence trades out of overbought RSI levels, although the traders couldn't rely on the nearby resistance level for stop loss prediction. So as you can see, it's quite a wee way away from that resistance level at 82.90, so it was very hard to get on the back of those divergences. Unfortunately, the RSI really couldn't be relied upon to square entry trades. For example, here at point 3, we see that the divergence, 145 pips sell-off down to around 81.20 here, but the RSI never reached this oversold level, so it didn't give us a squaring signal. The movements from the overbought and oversold levels were often well before the actual swing high and low was reached, making it often unreliable to use the trade signals from these rules alone. And you remember with classic trading, off the RSI, you would look to sell as it went out of the oversold level, stopping if it went back through, and buy as it moves out of this oversold level here. And we can see this problem here, whereby at point 5, you just find there we'd go around point 5 here, the RSI left the overbought zone here, only to revisit it shortly after, and it left us with a 15 pip loss. And at point 6, just down here, we require the ability to withstand 46 pip move after it's left this overbought zone. So it's a pretty painful sort of a stop loss that we need if we're trading just off the back of these zones. At point 7, it would have been pretty effective trades using the zones as indicators, although again reinforcing the point that the traders need to use another method or indicator to time the squaring entry, because we don't get back down into this oversold level, so we need to use some other methodology to square the trade up. The last point I want to make on this slide here is here at the far right, where we see the currency weakening. It's breaking its range here at the beginning of May. We get subtle clues from the RSI where it can't move back over the 50 neutral level during this whole period, and that's the largest period of time in that 2 months that it wasn't able to get above this neutral zone. So that gave us a clue as to the potential way that the move was breaking. And of course, when it broke the support, we then had complete evidence. So we're looking at now at the 4-hourly RSI. Using the streams as trade triggers would have only generated this one successful trade during the period after the range had been established. We got this trade here, but we didn't know the range. We had no stop to lean against, no support level at that point, couldn't have really used it. So not greatly useful. You can see on the daily RSI here, basically of no use whatsoever. So that's going to be expected where we see a currency in a range like this, where the daily average gains and losses are very similar. So we're going to see this with the RSI. That's why we focused on this hourly chart earlier. It was certainly the one to be looking at during that period. So now we're going to move on and have a look at the CCI, the Commodity Channel Index. So Similar rules to Demarco here. We go long when the indicator breaks up through the oversold. We'll set square when it comes back down from the overbought zone, or we'll stop out if it gets to, after buying here and it returns back to here, and same if we've sold here and returns back to here. So we looked at the 4 hourlies here. The daily CCI, like the RSI, generated very few signals. The hourly had many, but was quite random, and it was subject to noise flow of the market within the ranges. So this sort of time increment worked well in this type of stable range that moves from boundary to boundary over a few days. We can see the total profit around 439 pips to the period, 202 prior to this last trade, where we'll see it breaks the range and moves to a trending market here. Biggest winner was 237 pips. That being the trade where it broke the range. The interesting point to note, still 107 pip trade in the out of the indicator while it was trading ranges. Biggest loser only 62.5. The highest amount the trade was out of the money, any trade was out of the money, was a 66 pips. The highest amount that the trade was in the money was at 287 and even 168 whilst in the range. So you can see a big difference between the way it was performing, winners versus losers. So the buy signals are generally really good during this period. The sell signals often left decent chunks of potential profits on the table, but this is to be expected when we let the upside on the trade run and wait till the indicators turn and left the extreme zone before we close out. If you look at points 8 and 9, you can see it got right up to around 83.20, but did close it out to 82.43, so a lot left on the table. So the skewer of the turns after the trade initiation show how well the indicator performed to time entries. During the range, we saw maximum potential returns. Now, these are not locked in because of this contra signal waiting until the oscillators come out of the zones. So they were nearly 10 cents. The worst a trader could have done if they'd stopped at the worst point in every trade prior to the squaring signal was around 380 pips. So we'd see an excellent skew on how the trades were panning out prior to the exit signals. And this is what we expect of an ideal range trading oscillator during a rangy market, which helps buy near the bottom of the range and sell at the top. So we're going to move on to the MACD now and have a look at that. The signals were where the MACD line, the orange line, crossed the signal line here, the green line. It's a pretty typical way people use the MACD indicator. We can see prior to the last trade, the MACD, the last trade was again when it broke the range, but during the range it actually lost 159 pips. It was only this last trade that made it actually make a small profit of 42. The biggest winner being 201 pips, only 59 though in the range. The biggest loser 67. Three trades were in the money by over 100 pips during the range, yet the maximum that an indicator could lock in was only 59, so that's pretty disappointing. Being an indicator that's based on moving averages and its EMAs, it's prone to whipsaw trades and delays in the trade signals. And you can see here, comparing up the CCI, how the red arrows show how the signal's lagging the CCI signal every time, basically. So, and we know this with moving averages that they're going to lag price changes. So during ranges, moving averages will often tend to rotate around each other as the average prices are similar. So it's really not that surprising that the MACD didn't perform very well. And you can see here, this is actually on our website, it's a moving average crossover system. You can see during a range here, even though it is quite a whippy one, how the moving averages cross each other. It's the moving average based indicator is not going to work particularly well, but in a trending market, you can see the correct alignment of the moving averages with the shorter term one following the price most closely. It's far more suited to the MACD to a trending market. That's very handy for looking for divergence trades during the range, but not really great as an oscillator trader. So now I want to have a look. This is just a daily range, just recently, not the same period as earlier, but just to how effective pivot points were during on some days for range trading. Now the pivot points formed on the back of prior periods high, low, close. Typically they're used from the prior day's levels. They were developed originally by 4 traders to determine important key trading levels for the day's trading derived from the prior period. And this example uses these daily pivots. And we can see how effective they were for trading a quiet dataless day in the Kiwi during a session. And pivots work very well. You can see 2 good bounces off this level. A smaller third bounce that really you wouldn't have traded profitably given the width of the stop loss that you'd need. We can see that the CCI on the 5-minute chart here, the peak's getting lower. The CCI actually chimed in pretty well to help you on these bounces off the pivot point. And we can see the peak's getting lower in the CCI, sort of warning that the currency was going to weaken during the day. And we then see once we broke this pivot point, the first support level pivot point worked very well. We got 5 tradable bounces off this level here. 1, 2, 3, 4, 5. So maximum potential gains are around 120 pips. It's pretty amazing. I mean, obviously you're not going to be able to lock that in, but and this last trade here, it failed around the 81.76 level, and then was down as low as 81.13 within 18 hours. So they can be very useful if the market's lacking direction. No major data being released to guide intraday range trading. So now I'm going to talk a bit about establishing the range. A major issue for trading range is trying to find what it's going to be before it occurs. Because obviously a lot of range trading opportunities will have already occurred when we start to figure out what the range is. So we're going to look at some slides now. Bear with me here. Maybe small, I'll just increase size. Now this is the same ranging period in the Kiwi. Now ignore the fan lines. We're actually looking at the retracement levels here, the 38.2, the 50 and the 61.8 from this move down from the high here at 84.70 to this major swing low around 81. We can see this first point 1 here, that this move up to 82.80 failing within around 5 points of this 50% fib level, which is tiny in the context of this 370 pip down move. So the fibs were great here, and it defined the peak of the range for over a month. And at point 2 here, we can see a failure just 5 points through the 38.2% level. Point 3, we see another peak, again back at the 50% fib, only exceeded it by 2.5 pips. Point 4, see another failure here, the 38.2. And 2 further peaks came within about 7 points here and here of the same fib level. The first one here was just under 7 pips off that level, and you probably would have missed it. But the second peak, I've called that trade 5 because you could certainly get in the back on that one because it was exactly the same level as where it failed earlier in the range. So you can see that the fib really worked really well over this period. Interesting to note here where we have the asterisks. See failure about 1.2 pips higher as the prior asterisk level before it fell. 82 pips Another great little range trade, not defined by the fib, but certainly one that you could have been on the back of. Just going to zoom this back out a bit, so we'll move on to the next one. This is the same range. We're now drawing the fib retracement with the second major swing low. The yellow arrows are denoting the previous slide's trades. So 0.6 this time, we can see failure within 2 points of this 50% fib level. With 0.7, another failure at the same level. 0.8. We'll see new highs. This was quite difficult. It broke the old range highs of 82, 87. Although once again we saw the Kiwi failing within a handful of points of a major fib here. This time this 61.8% level at around 83.13. We had a nice 40 pip dip en route to 83.14 from 83.17. So a couple of small trades, then a nice move back off this level. Then we break the bottom side of this range. Basically, by looking at the fibs on the two slides, we pretty much got every peak during the period. So a really good thing to look at for trading ranges when you get a great range like this. And here's another one. This is different currency. It's the Kiwi Sing, but again, just pointing out the power of the fibs here. From the yearly highs to the yearly lows, tracement fails perfectly here at the 61.8% level. Does this 4 times in this zone here. It's difficult to see on that slide. We can see when it broke through this level later in the trading range, it failed at the old support zone set back here. So that, although it was pretty difficult, that helped us sort of to see how support resistance sort of helped us guide us and where the range may have broken down. And we can also see two major swing low sell-offs here at the 98.65 and 98.83, stopping at the 50% fib retracement of this level here, where we moved up here to here, then pulled back 50% of this move twice. So fibs really, really a great help. You should be looking at them when you're trading ranges every time. So we're now going to move into the transition between the ranging and trending markets and when to change your trading plan and style. And so we've had a nice fruitful period trading a range. We need to make sure that when the range breaks, we're out of this range trading mindset. And it's imperative to recognise this transition. So as many of you know, the 8 is a great indicator to help us. We can see the red line here being the negative directional movement indicator and the blue line the positive. We can see that during the ranging market on the dailies here, they rotate around each other. As the range breaks, we get them dispersing and moving in different directions to each other. So it's a great indicator to let you know when the range is changing. And also the ADX, which is an average of the two. It's derived from an average of the two. That will increase when the range breaks. Some other things that you might want to look at. You can look at the Bollinger Bands here. We can see compression of the bands during the range, expansion of the bands when the range is breaking. That's a key thing to look with Bollinger Bands. Interesting thing here for MACD, again the rotating of these two EMAs around each other during the range, separation like we saw earlier when we talked about moving averages when the range breaks. You get a good signal here where the MACD crosses the signal line and support break, and of course confirmed by the ADX. So longer term charts like the one we just looked at help us position for the eventual range breaking out. Looking at the MACD chart, Just flip back to one we were. We can see a divergence here in the MACD line. We get higher highs in the Kiwi, the top of before we enter the range, but the MACD's coming off. So that's where the MACD's useful. You can also see that the MACD and the signal line during the range failing to get above zero. That was another good indicator of the waning momentum here. We can use other indicators like the RSI, the Demarco, Chanda momentum oscillator, and others for these sorts of patterns. And it's rotating our risk consistently throughout this range has given us a lot of ammunition to position for a breakout. And once we've seen these signals here, we can then strap some risk on and make the most of it. The ATR is another one that's worth looking at. You can see how it changes between a ranging market and a trending market. You often get the ATR declining or trading in a channel and then breaks up out of these channels when they change from a ranging to trending market. So that's another one to have a look at. So lastly, it's going to run through a few things, navigating the break. The breaks can lead to increased volatility very quickly. Many times, many things can happen. Often a strongly trending market will develop, although sometimes the pair will leg into a new range. So trending technical tools like what we've discussed help us detect which might be the case. Normally doesn't pay to attempt to try and trade a new range too hastily. Let it settle down, the market settle down, establish normalcy. The market's going to often have some false breaks, trade out of the range, following traders into thinking it's moving to new levels. And the 4-hourly RSI, we saw that on the Kiwi where it broke about 30 pips higher. They're tough to trade, these breakouts, these false breaks, but you can look for divergences on your technicals to help with establishing whether a break might be real or not. And also look to your volume indicators like the advanced decline divergences on them. False breaks typically going to occur on light volume. Real breaks will be heavy volume. If a false break happens, be wary of a break in the other direction, which will normally signal the direction of the new trend. If you've gone with the direction of the false break, be quick on your feet, reverse your position if the pair trades back into that old range. And I think you'd best be mindful of where the currency's trading with respect to long-term ranges. Daily charts and longer, but where you should focus when you're examining the health of a range. Looking at the short-term charts will confuse your mind clarity, obscure what's happening to the long-term structural supply-demand equation, which will set the pricing in the future. So look out for chart patterns like, double, triple tops, bottoms, head, shoulders, reverse head and shoulders, flags, things like that. Lastly, I'm just going to quickly talk about navigating false breaks. Here we have the EuroCAD chart. I like to set stops at levels where everyone else is not going to be. Think independently. Don't place your stop with everyone else. Smart money will be, often sourcing the stop liquidity run to position for a false break. So if we look here, we can see in this example here, the buying's been filled in with supply at the top of the range. We trade slightly higher. Shorts are taking out. The buying's exhausted. When the normal supply-demand conditions return, the market slumps. We see it coming straight back down. All the shorts are gone. There's now no buyers at the bottom of the range. Nobody's short, so it just continues south. So you need some other things to look for are lower tops and bottoms within the range, and the inability of oscillators to trade back towards the other side of the range to help indicate as to what side that range break may occur. So if you remember back to that 1 hour RSI, that showed us well that situation. Lastly, it's a couple of points. Normally, I think pays not to try and be smart and anticipate a range break. It's usually better just to wait till the range breaks before being aggressive. A more conservative stance may be just not to attempt a final range trade if your techs are telling you the market's about to break out. And lastly, be aware of ranges within ranges. Dynamic traders may be able to trade ranges that lie within each other successfully, but it is more difficult practice, and it's easy to end up with larger positions than what you intended, which will put your discipline to the test, and it's probably better left to more accomplished traders, I think. And that's the end. You can follow us on Twitter at Mahi Forex, and there's and on Facebook as well. Our website www.mahifx.com. So I hope you enjoyed that. Now I'm going to turn it over to anyone who may have a couple of questions. Okay, would you recommend, Michelle saying, selling into false breaks? That's a good question. Very difficult one, because when the break's false, you're not going to know at the time. It's only with the benefit of hindsight that's going to be apparent what it was. I think there's a few things to think about there. It depends on how well the range is formed, how long it's been trading it. So you can naturally look to your technical indicators for assistance. If it's early in the range, you've probably made very little money from trading the range, and the boundaries are less defined, so the breakout could easily be, very painful and real, so you need to be wary of doing so at that point. I think earlier in the range, it's probably just safer to stop out and re-enter the trade as it moves back into the range, and this can be applicable later if it happens too. Later in the range, you're more likely to have made a lot of money, so you'll have the ability to sell more into the false breaks more readily. The break's probably going to be more predictable, but you need to remember that more hits on the zone extremities during the range, and you need to be careful about the break. So I think, again, sitting back, watching to see if it breaks back in the trading zone's a better choice. It's also going to depend on where your entry point is. If it's close to the range extremity, you're going to have a better ability to position your stop out of danger than if you'd scaled in. You're going to have less latitude. Another point, I think, consider how far away your take profit is. If it's 200 pips away, it's going to make more sense to add to your position at the false break and have you stop away from that false break zone than if you'd only got your take profit 50 points away. And in Asian ranges, one thing I like to do is, if you've got minor support resistance and fuzzy boundaries in the short-term charts, put some of your risk on at the extreme, so 2 out of 5, add another couple of 3 units, a few pips outside the range, positioning a stop a handful of pips further out, because often the market's going to hunt the New York, London overnight highs, lows, clear them out, and then a few pips and then reverse. What else we got here? Sorry, Boyke, I missed that earlier. Do we have anything else from anyone? No, we're looking like everyone's pretty happy there. Yeah, I'll just come back to you in a second, Boyke. I'll just answer quickly some of the point on other oscillators worth looking at, and then we'll quickly back to you. I had a look at the CMO. It was very it appeared to work pretty well. It was similar to the CCI, more prone to on the noise-related signals in the hourlies, but the 4 hourlies certainly looked pretty good. I think trading on a more short-term basis would have had mediocre results. I think I need to point out it can be a bit redundant and non-productive to use too many oscillators that essentially tell the same story. So a lot of analysts will just prefer to use 1 or 2, learn their complexities, than depend on many signals from many. So, for instance, the Williams percent R is similar to the Stochastics, and instead of comparing the current close with the low of the window which is what we see for stochastics. That the percent R compares the close with the high. So percent R is telling whether currency is a relatively high point in its trading range, and stochastics whether it's at a low point. So the CCI is also very similar to stochastics. I think you can end up by duplicating efforts and having a false confidence just by using too many indicators. And you can see that the CCI and stochastics in our example yielded similarly positive results. Sorry, Borky, I just need you to, which slide were we looking at when you asked that question? I missed that one. Do you mean exit when you say square up? Okay. Yeah, but when I say square up, I mean exit that trade. That's right. So, for example, on this one here, we're going long when down here when the percent K crosses percent D. I remember them as quick and dawdle, and we exit the trade at square up when it crosses back. So that's right. Cool. So you've all got those slides. I mean, I know unfortunately they might have been a little bit small, but you can maximise them on your screens and have a good look at it. It's a great example, probably the best I could see all year actually. It hasn't been the best year for range trading, but it's definitely a good tool to good to know the tools and how to use them during ranges, because it's amazing how much money you'll make. And typically I think a lot of traders are going to make more money out of trading ranges than trends, because it's less easy to cut yourself up in a trend that's so tempting to average or go against the trend, try and catch the falling knife, which really can be disastrous. But obviously if you have a great trend in one direction and you're on the back of it, you're gonna be laughing. But often, it's tempting to square up. Then the trend continues and you're kicking yourself. So it's really great to know how to trade ranges properly. The 4-hour charts, I think the reason I think they work so well, and I do look at them for trading ranges, is during these periods where you get it moving from one side of the range to the other over, of course, a few days. It's about that right time increment to trade off the back of the oscillators. Whereas in the 1 hourly, for instance, you're going to get a lot of noise and random flows just affecting the indicator, and it may not be anywhere near the extremities of the range, and you're just probably going to more likely find yourself getting cut up. But I think it's certainly just pays to perhaps go through this period. It was a great period. It was March, April. Run other indicators, different time periods, and test it yourself. Do your own research. I tend to like a slightly longer period. I'm more of a swing trader. I think it's very difficult to trade, especially if you're starting out short-term time periods. Your 5-10 minute indicators, I just think they're dictated by noise too much rather than real momentum. You're going to get chopped up. Unfortunately, as you saw, the dailies weren't really of any use for trading the oscillators, but where they come in really handy is for looking at when the ranges are changing to a trending market and when they're breaking out. So it's so important, I think, to start with those long-term charts, move into 4 hours. Sometimes your 1 hours might work well, and you may even have some luck from time to time with some shorter-term stuff. But I think in general, I'd be surprised if you could consistently make money using the oscillators on short terms. So is there anyone else with anything they'd like to ask? Okay, well, we'll wrap that up. I hope you all enjoyed the session, and we'll look forward to the next webinar that I'll be having sometime in January. Cheers, thank you.